In this video, I'm going to cover the topic of deducting your medical expenses. And let's face it, the cost of your medical care, including your health insurance premiums, has gone through the roof. But at least I'll be able to teach you how to get some tax savings related to these expenses that you are incurring. So yeah, I'll start off by covering the basics such as itemizing your deductions, the flexible spending account, and health savings accounts. But I'm also going to take a deep dive into the health reimbursement arrangement. That's what this video is about, okay? You might hear these called HRAs. So if you continue watching this video, you can expect to learn what are the benefits of an HRA. What about HRAs for business owners who have employees other than themselves, as well as HSAs for business owners that are sort of sole practitioners, right? So they may operate their business as a sole proprietor, partnership, S corporation, or even a C corporation. But the point is, you don't have any employees, it's just yourself. How do you leverage the HRA in that scenario? And I'll even teach you how to execute this strategy all along the way while teaching you the basics. So I'll show you some sort of enhanced things like how to save Social Security and Medicare taxes if you're an S or a C corporation, as well as how to save just your regular federal and state income taxes by leveraging the HRA. That said, before I dive in, let me introduce myself to you if it's your first time watching one of my videos. My name is Navi. I'm a certified public accountant who teaches entrepreneurs how to save thousands of dollars in taxes each and every year. I do that by providing free content you're watching right now, right here on social media, but also through a comprehensive course, which is designed to convert business owners from really knowing nothing about taxes and transitioning them and converting them into tax-savvy entrepreneurs who implement strategies that save them thousands of dollars in taxes. And like I said earlier, it's each and every year, not just a one-time tax savings. So if you're interested in learning more, you can click on the link within the description below or visit my website, which is navimirajcpa.com. Okay, so without further ado, I wasn't kidding when I said I'll be teaching you, as this is a class. I'm going to share with you a presentation I did at the Tax and Legal 360 event in Phoenix. So grab a snack and maybe a drink and enjoy.
The various things I'm going to cover are, what are your options when deducting your medical expenses? And specifically, I'm going to tell you, you can itemize, you can do an HSA, you can do an FSA, an HRA. And of course, then I'll dive deeper and talk about what exactly is an HRA, the benefits of one in regard to employee retention. That might be the reason why you bring it in, or establish one. Or I could show you the tax savings if you're one of like an owner-only type of business where you don't have a ton of employees. Then I got some bonus content for you. I don't want to give that away just yet, but it's gonna help you save money on what Marx calls the F word, right? So FICA tax. And then how to actually execute this strategy. The thing with the HRA is that how you execute it depends on how your business might be taxed. So whether you're taxed as a sole proprietorship or an S corporation, it's going to be a little bit different. And I'm going to teach you just how you're going to implement each one. Okay, so let's start off by doing the options when deducting medical expenses. So these are pretty much the four options here. I'm going to start and go from left to right naturally. So number one is you could itemize. And actually, before I jump into this, can you just by a show of hands tell me who here is like a tax preparer, like a tax professional? Okay, like everybody. And then who here is just like a non-tax professional, business owner, real estate investor? Okay, so a handful there too. Okay, cool. So a lot of you guys know this, but for the handful of folks that are just like a business owner, you're not preparing tax returns every day, you can get a deduction for itemizing your medical expenses, but it sucks. Okay, the reality is it sucks. The way it works is you can only deduct medical expenses that exceed 7.5% of your what's called adjusted gross income. So in an example where your adjusted gross income is $100,000 and you incurred $7,600 in medical expenses, the way the math would work out here is that only 100 of those dollars would even go towards your itemized deductions, okay? And then your itemized deductions would then have to be greater than your standard deduction in order to get that. So basically, it's not happening, so I wouldn't even go that route, okay? It's probably not gonna work out for you. The second method is through a flexible spending account. Who's heard of a flexible spending account? Okay, good. So these are typically offered if you have like a W-2 job, maybe not yourself, perhaps your spouse has a W-2 job, and you have a flexible spending account offered by your employer. So these are one of those plans where it's great, but it's a use it or lose it plan. So your employer might offer you to put in, the 2023 limit is $3,050, and you can contribute that much and receive a tax deduction for it. But the key thing to remember is, ideally, prior to year end, you want to pull that money out and actually get reimbursed for the expenses you incurred, or else you're out of that money. Okay, so you want to make sure you pull them out. So it's great, but just proceed with caution there. The health savings account, I had someone ask me about health savings accounts and if I was going to cover that. Yesterday, actually, Carter put on a whole separate presentation regarding HSAs, but the high-level overview of what the HSA is that this is great for employees as well as small business owners. So you don't have to be a small business owner to take advantage of an HSA. You qualify for an HSA by having a high deductible health plan. And these are the limits that you can contribute into your HSA. So again, I'm not covering the HSA in this presentation, but I encourage you, if you're watching at home and you want to learn more about that, please check the recording of Carter's presentation. It'll unpack the HSA for you. It's an excellent strategy. What I'm going to be talking about is the health reimbursement arrangement. So unlike the HSA, the HRA is for small business owners only. So if you just have a W-2 job, right, and you're not a small business owner, this is not necessarily available for you. It's not a savings account, and it's not tied to health insurance. So technically, you could be an entrepreneur without health insurance and still use an HRA. And essentially how it works is the business is going to reimburse you or your employees for medical expenses that you incur. All right, so that's the high-level overview of your various options when deducting medical expenses. Now, let me give you the sort of technical definition of what an HRA is. It's an arrangement that is paid for solely by the employer and not provided pursuant to salary reduction election or otherwise under a 125 cafeteria plan. I'm not going to actually read the rest of this slide. It's kind of boring information, but essentially what this is saying is that your employer will fund this account for you, and then you will turn in your medical expenses to your employer and receive a reimbursement tax-free. That's essentially what this slide is saying in plain English. Okay, but what is the benefit? This is what you want to really understand is like, well, why should I have this? Well, you know, you're talking about HRAs, but what is it going to actually do for me? So if you're a small business owner with high out-of-pocket medical expenses in your immediate family, you can deduct those expenses using an HRA, right? You don't have to worry about the FSA because that's probably not available to you as a small business owner. You don't have to worry about itemizing your deductions because that's likely not happening either. And so you have this option, right? The HSA, you may not be eligible for that. You may not have a qualified plan that's HSA compatible, if you will. And so this might be the only option for you. You can have an HSA and HRA at the same time, but there are quite a bit of nuances around that. I'm not going to really get into those various nuances. So I do recommend consulting with an administrator. That's like a company that establishes HRAs for companies, and they can kind of tell you how like the interplay works between both of those. Just in this example of how much money you can save, in a scenario where a family has $10,000 in annual out-of-pocket medical expenses, the tax savings can be anywhere from 10 to 40%. Where am I getting this 10 to 40% from? This is basically just your marginal tax rate. And so depending on what your marginal tax rate is, will determine how much your savings is. So assuming you're in a 22% bracket for federal purposes and a 5% bracket for state purposes, then on $10,000 of expenses, you could save $2,700, right? If you have $20,000 in medical expenses, $5,400, and you can do the math, right? If you're in a higher tax bracket, then you're going to save even more money. Okay, so what does an HRA cover? What can you use the HRA for? It's really the same stuff, if you will, that you may have learned yesterday if you did attend Carter's class, but it can cover your health insurance premiums and medical expenses, okay? Now, there are some HRAs that do not cover the reimbursement of insurance premiums. So this is, I think, my last time that I'll say, hey, make sure you get with a plan administrator just to make sure that your health insurance plan is sort of compatible with this and allows you to deduct your premiums. Some examples of premiums that are not reimbursable are life insurance, loss of earnings, accidental death, and you can see the others that are listed here. Okay, so what is a medical expense? Medical expense, again, here's the definition. It's the cost of diagnosis, cure, mitigation, treatment, or prevention of disease, and for the purpose of affecting any part or function of the body. Well, that's pretty broad definition, but as you can imagine, there's a lot that goes into that, right? And so I've linked this IRS publication. If you download the slides later, that should be a hyperlink that will take you to the publication automatically. But buried in there are, I don't know, hundreds of examples of deductible medical expenses that you can have a look at and see if any of them pertain to you. I pulled out some that I thought were expensive and interesting. So you could do acupuncture, chiropractor, braces, eye care, LASIK eye surgery, IVF, infertility treatment, procedures and operations. And in the event you or a spouse or someone in your household has to install special equipment in their vehicle or in their home, depending on the disability that you may have, that would be covered as well. Okay, don't double dip. I don't know, were any of you double dipping in the meals that we had yesterday? But what I'm trying to say here is be mindful of double dipping. If you already receive your health insurance premiums on a pre-tax basis, or are using an HSA for a particular medical expense, you can't use your HRA for that same premium or that same medical expense. That makes sense, right? You can't get double a tax deduction, okay? To expand on that just a little bit more, like let's say your spouse has health insurance offered through her employer, his or her employer, you're already getting those medical insurance premiums on a pre-tax basis. So then you can't go and double dip and try to get reimbursed from your HRA for those same medical expenses. Okay, here's where things get a little hairy. So HRAs are a fringe benefit, okay? What that means is, well, let me just kind of read some of this stuff to you because it's important. Under IRC Section 105, HRAs are considered a non-taxable fringe benefit. Okay, you can read the IRS publication about that. As a result, the way an HRA works for an owner of a business and a non-owner are going to be different. Okay, let me say this a little bit differently. So a non-owner employee can receive the fringe benefit tax-free, whereas an owner employee cannot. Okay, so where am I going with this? I want you to understand that you might think you're an employee of your business, but the IRS might say differently as it relates to fringe benefits, okay? What does that mean, Navi? So what I'm saying here is a sole proprietor is not an employee, okay? So if you're operating your business and your business is on a Schedule C on your tax return, you are not an employee, okay? A partner in a partnership, if that's the way you run your business, you are not an employee. And I know I'm gonna get some pushback here, but an S Corp owner, even though you're a shareholder employee and you're running reasonable compensation and you have a W-2, you are not an employee for purposes of fringe benefits, okay? A more than 2% shareholder in an S Corp is actually treated like a partner for fringe benefit purposes. Because of this, I need to present in such a way that you know how this works when there is only one employee, which is you, versus when you might have multiple employees, okay? So that's what I'm gonna do next. In case you're looking for proof, like, I guess, let me ask you guys this, just by a raise of hands. How many of you kind of knew that, hey, for fringe benefit purposes, and I'm running an S corporation, I'm not an employee? Raise your hand if you knew that. Okay, so, you know, there was only like about eight of you or so that said that. So I'm gonna go ahead and read this to you just so you know where the proof is and you can go kind of check on it later. So in section 1372A, it states that for fringe benefit purposes, an S corporation shall be treated as a partnership, and a 2% shareholder shall be treated as a partner of such partnership. A 2% shareholder is one that owns more than 2% of the corporation's outstanding stock on any day during the S corporation's tax year, considering direct and constructive ownership. And if it wasn't like even worse, let me just add one more thing here, which is that under the family stock attribution rules, a person is considered to own the stock owned by that person's spouse, children, grandchildren, and parents. Okay, so you might have children or grandparents that are, kind of attributed to the ownership of your company, and you may not even realize it. Okay, so here's how I'm going to unpack this for you. On the left-hand side, basically what I'm saying here is these are the options if you want to establish an HRA in your business and you have multiple employees. When I say multiple employees, I mean you have regular rank and file W-2 employees in your business, right? It's probably more like a medium-sized business. And on the right-hand side, I'm saying, hey, I'm then going to now show you what are your options and how to implement these strategies if you're like an owner-only business. So by owner only, I mean you're a sole proprietorship and it's just you. You don't have W-2 employees as well. Or maybe you're running your business as an S corporation, and again, it's just you. You don't have W-2 employees. It's just you yourself. Just out of curiosity, for those of you that are business owners and tax professionals, I'm just curious, like how many of you are just like one-man show? You don't have W-2 employees. Okay, all right, a lot of you have W-2 employees, that's good. All right, so let's start on the left-hand side. So, this might be something you might want to implement in your business. I didn't see a lot of hands go up, so that means a lot of you actually have quite a few rank and file employees in your business. So I'm going to read this to you. I learned recently that this is actually pronounced QSERA, but specifically designed for employers with fewer than 50 full-time equivalent employees that don't offer traditional group health insurance. Okay, so that might be you, right? You have W-2 rank and file employees, but you don't offer a group health insurance plan for those employees. With the QSERA, employers can set an allowance for employees according to their individual or family status. They have contribution limits that are set by the IRS each year, and allowance amounts typically roll over from month to month. The QSERA must be offered to a full-time W-2 employees, and additionally, you can choose to offer it to part-time employees, but if you do that, you have to make sure that the part-time employees receive the same benefits that you're giving to your full-time employees. Reimbursements are also free from income tax purposes, and if the they're only free from income tax purposes if the employee's policy provides minimum essential coverage. What is minimal essential coverage? It's basically a plan that meets the Affordable Care Act requirements. If you're curious about what those amounts are, a business can offer almost $6,000 for self-only employees, which is about $500 a month, and $11,800 for employees with a family. These numbers are adjusted for inflation every year, so the numbers for 2024 are slightly higher. So I know there was a lot on this slide, and essentially what I want to say here is like, perhaps I'm repeating myself a bit, but this is a plan that you might want to establish in your business if you're trying to retain employees, right? Maybe you can't afford to pay for group health insurance for your employees, but you want to say like, hey, no, we don't offer a health insurance benefit, but what we do offer is a HRA, and we will reimburse you for your medical expenses that you have up to a certain amount, okay? And that might be something that helps you either retain talent or attract talent. Okay, going the wrong way. Now, I don't know what they call this one, the ICHRA. I was trying to make a funny joke and see if it's like the HRA or how I pronounce that. But anyway, the ICHRA works much like the QSERA, but it's available to organizations of all sizes, okay? So for those of you who might be watching online, who have a lot of employees, greater than 50, then this might be an option for you. It comes with no contribution limit. So the IRS doesn't limit how much you can contribute. And it allows businesses to offer different allowance amounts based on 11 employee classes. So essentially what I'm saying here is it allows you to discriminate, okay? So you might have a little bit of a different contribution limit set for full-time employees versus part-time employees versus salary versus hourly or something like that, okay? This is only available to employees with an individual health insurance policy, okay? With having said that, employees covered by a family member's group policy or an alternative like Medishare can't participate in the benefit. So if you establish an HRA for your business and your employee receives their health insurance through a group plan at your spouse's job, then you actually, as an employee, can't take part of your employer's ICHRA. So it's a little tricky. That's why I tell you, if you're actually going to do something like this, you want to get with the plan administrator to like kind of work out all those kinks and details so you don't get yourself in trouble as the employer. Okay, this is a quick chart I made as comparing the QSERA and the ICHRA. It basically is a summary of the previous 2 or 3 slides. So you can grab a shot of that and it's available in the slide deck if you download it later in the HOVA app. HOVA, whatever. Okay, now let's get into the juicy stuff here. So this is for the, again, business owners or entrepreneurs who are running their business as a sole proprietorship. And so remember, you can have a sole proprietorship whether you just, went out there and started running your business, or you might have a single member LLC. So by default, single member LLCs are taxed as a sole proprietorship. So essentially what I'm just saying is your business tax return is prepared on a Schedule C. So how does this work? I know I got a ton of bullet points here, but what this does is when you execute the HRA on a Schedule C, it's not only saving you federal and state income tax, but it's also saving you on self-employment tax, right? And self-employment tax, for those of you that don't know, is roughly 15.3%. In order to do this, you need to execute and maintain a formal HRA plan document. And so, I've said it like 5 times, but you want to get with a plan administrator if it's your first year. However, if you're in the Main Street Certified Tax Program, I believe the legal team over there has put together a generic HRA plan document, and you can sort of download that document and give it a look if you wish. The way this works is, let's pretend I'm the sole proprietor, okay? I would have to hire my spouse as an employee, okay? And when I say as an employee, I mean like give them W-2 wages. Why? It goes back to what I had said earlier. It's because you, the proprietor, are not an employee. And remember, HRAs are for employees only. They're a fringe benefit, okay? You may reimburse, expenses related to the employee and the employee's spouse, which would be me, right? Including my dependents and a child of any employee who's under age 27. So essentially what I'm trying to say here is like, it's gonna end up covering my medical expenses, my children's, and my spouse's. You wanna actually document your hours worked on a timesheet, okay? I know this is like a lot of stuff that I'm telling you that you have to do. The reason why I'm going into all this detail is because I don't want you to think like, you watch some TikTok video and they say, oh, you can deduct all your medical expenses and poof, you do it and that's over, right? I want you to understand there's documentation that you need to actually have just in case someone questions this, okay? So you want to document your hours on a timesheet. Your spouse, right, who's now the employee, they should be the one paying all medical expenses from a separate personal account, right? Normally with a sole proprietorship, technically you can kind of like get away with commingling funds, but if you're gonna use a strategy like this, make sure you have a separate business account and your spouse has a separate personal account specifically for the medical expenses. The spouse employee is going to submit the medical expenses to the employer. So in this instance, my wife would be submitting those medical expenses to me, the sole proprietor, for reimbursement, okay? And then my spouse is going to receive compensation. So my spouse's compensation is going to consist of the medical expense reimbursement. Be sure to make this amount reasonable based on that work that my spouse is providing. So let's say my spouse is like helping me with, I don't know, I'm just giving an example of bookkeeping, right? And she's taking care of like 2 clients for me. But her medical expenses are, for whatever reason, $30,000. Well, if she's only helping me with like 2 clients a month, like it probably doesn't make sense to give her wages of $30,000 just because that's what her medical expenses would be. So it's got to be a reasonable amount that you're compensating your spouse. You probably should issue a W-2 to your spouse, but there have been tax court cases about this that it's not technically required. Now, I get it. There's a lot that I put on this slide. Probably should have broken it up into two. But if you have questions about some of the stuff that I mentioned on the prior slide, I would like you to, I guess, cross-check it with this court case, because in here, this sort of case established that an employer and employee relationship exists between an employer, which is me, the sole proprietor, and an employee's spouse, which is the spouse that I hired, okay? So the IRS has confirmed, like, yes, an employer and employee relationship exists, even though the person is my spouse that I hired. Medical expense reimbursements are excluded for income for the spouse employee, all right? So when I reimburse my spouse for the expense, I'm getting a tax deduction. And when my spouse receives the reimbursement, it's excluded from income, all right? This case establishes that. And the last bullet point here, in this particular case, only compensation paid was medical reimbursement benefit, and the benefit was considered to be compensation. What does that mean in plain English? I'm saying if your spouse you hire at a rate of $20,000 a year, and all that was included in that $20,000 were their medical reimbursements, the IRS has said, that's okay, that is compensation, and it's considered compensation paid for this purpose. Okay, backwards. The trifecta. So here's kind of what it looks like on the trifecta. You have your Schedule C business, right? You've established your HRA, and you've hired your spouse, and your spouse's compensation is going to consist of those medical reimbursements. I'm sure you'll have some questions about this, and I do not plan going the full hour, so there'll be plenty of time to ask questions about this. All right, here's a couple things I want you to keep in mind as it relates to executing this strategy. And this applies to sole proprietorships as well as S corporations, which I'm going to get into next. And that is questioning who is an employee in your business, okay? So in my example that I've been using, where I'm the sole proprietor and I am employing my wife, and she's going to be on a W-2 employee, I also need to be cognizant of what if my wife had her own business and my wife hired employees in her business? Are those employees now my employees? Well, unfortunately, they are. You have to be mindful of what these controlled and affiliated service group rules are. So essentially what this slide says in plain English is that employees that I hire in my sole proprietorship, I would have to offer them the same benefits as I offer my spouse, but also too, employees that I might have a majority interest in, right? Even though like I don't maybe have all the full decision-making responsibilities, if there's a side business somewhere else that I might own, 60% of, well, now those are all employees that I should be offering an HRA to. And even if I have a spouse that has a business, those employees in that business would need to be included in my HRA. So essentially what I'm trying to say here is like, don't do this if you have rank and file W-2 employees, unless you want to cover them as part of your HRA benefits. Okay, but who is not an employee? So I know it's a bad thing, but in this case, it's a good thing. You get to discriminate a little bit. So let's say, again, in my sole proprietorship, I do have employees, but those employees have not completed 3 years of service yet. Well, I don't have to offer my HRA benefits to them. If the employees are under age 25, or if the employee is considered like seasonal or part-time work, I get to discriminate and say, hey, sorry guys, you guys are not covered for my HRA, but my spouse is. Here's the source code for that if you want to look into that a little bit further. My note here at the bottom is saying, be careful not to exclude one of the above if it includes how your spouse will qualify as an employee. So again, I didn't plan on using myself as an example here, but the example here would be, okay, my wife's working for me part-time in my business, and I'm giving her an HRA benefit, but in my HRA document, I said I am excluding all part-time employees. Well, now I've just excluded my wife, right? Because she's a part-time employee. So now I just kind of eliminated my benefit. So just be careful when you're when you are discriminating, be careful with it because you might be discriminating against your very own self. Okay, S corporations now. So I'm switching gears here and I'm gonna now talk to you about how to incorporate the HRA strategy when your business is taxed as an S corporation. So by a show of hands again, if you don't mind, I know we had a ton of business owners and a ton of tax professionals, but how many of you operate your business as an S corporation? All right, so this is the juicy stuff. This is what you really want to be learning about. Okay, so there's two ways I could teach you this, and both are valid, okay? The first way is how to include the HRA as part of your reasonable compensation. If you execute it this way, you're gonna save FICA taxes, so 15.3%. The second way is slightly more aggressive. I'm gonna be introducing to you something called a medical C corporation. With the medical C corporation, the tax savings you're gonna receive here is whatever your federal income tax and state income tax marginal tax rates are. So saying that a different way, if your federal and state marginal tax rates are greater than 15.3%, then perhaps it might be better for you to go the medical C Corp route. That'll make more sense here in just a moment. Okay, let's get into some of this bonus content I was talking to you about. What I'm gonna sort of present to you here is how to deduct your health insurance premiums and your HSA contributions as an S corporation officer. And this is gonna save you thousands of dollars in FICA taxes. I'm telling you right now, I can almost guarantee that a lot of you guys who are running your S corporation are not doing this in the way that I'm gonna teach you. And I can almost guarantee that it's gonna put at least $1,500 to $2,000 in your pocket every year. So pay attention here as I go through these next slides. Okay, let's talk about health insurance premiums. How are you gonna deduct these? So generally, if you're a small business owner, unless you or your spouse have access to an employer-subsidized health insurance plan, you can receive an above-the-line deduction for your health insurance premiums. This includes medical, dental, and vision premiums, okay? Just to define what I mean by employer-subsidized health insurance plan is you will not get an above-the-line deduction for your health insurance premiums if, again, in my example, if my spouse has a regular W-2 job and her W-2 job offers group health insurance, then I'm not gonna be able to participate in this because her group insurance is being subsidized, right? Her premiums are less than what they would be because she's in a group plan. Okay, where is this tax deduction taking place? So even for those of you that raise your hand that are not tax professionals, download your tax return, have a look, and ask yourself, on Schedule 1, Part 2, line 17, do I have a number here under self-employed health insurance deduction? And if the answer is no, then you just want to ask your tax professional why that is. There might be a valid reason for that, right? An example would be, oh, that's because, Navi, your wife participates in a group health insurance plan, so you don't qualify for this. Or, unfortunately, the answer could also be, oh, I didn't know you could do that. So, you want to just double check, okay? Here's how this works. Here's how you actually deduct the premiums. Your health insurance premium should either be paid directly out of your S corporation's business account or reimbursed via an accountable plan. The total cost of the premium should be included in box 1 of the W-2, okay? They are not subject to FICA, so they're not included in boxes 3 and 5. I know I'm getting granular here for the business owners, but bear with me, I've got a slide on this and I'll show you exactly what I'm talking about here. The cost of your health insurance premium should also be included in box 14 of the W-2. That's for the federal, amount. I believe it would go in box 16 at the state level. Deductions takes place on Schedule 1, where I just showed you a moment ago. So let's look at this in action, okay? Here's what you're gonna do. For you S Corp owners out there, you've already determined your reasonable compensation, right? Well, what I'm telling you to do is instead of, what you'll typically read online about this is instead of subtract for step 2, they tell you add your health insurance premiums to your reasonable compensation amount. So let's throw some numbers on this, okay? Mark often uses the example where you have $100,000 in profit in your S corporation. You may take reasonable compensation of $40,000. And in that situation, if your health insurance premiums were, let's say, $10,000 for the year, a lot of people do this, okay? Look at the left-hand side here. They will take their Social Security wages of $40,000, that's their reasonable comp, and they add the health insurance premiums to box one. And if you read the instructions and guidance on how to do this, that is kind of what it says. It says to add it to box one. But what I'm telling you to do is, instead of adding it to box one, subtract it, okay? Why am I telling you to do this? Because you've already determined that $40,000 is reasonable compensation for yourself as the S Corp owner. So why are you giving yourself more compensation through your health insurance premiums, okay? Your health insurance premiums are a form of compensation. If you read box one, it says wages, tips, and other compensation. So if you've already determined that $40,000 is reasonable comp, then you can actually run your payroll for $30,000. What does this do? Well, you can kind of see the savings here. Instead of paying FICA taxes on 40 grand, you're now paying it on $30,000. So that saves you $765 for the employee and $765 for the employer, for a total of $1,530. I could tell because some of your mouths are like, you're staring at this, but how many of you are actually executing it in this way? Be honest. Okay, so I think like 5 people. And I saw a lot of tax professionals raise their hand and a lot of business owners raise their hand. So it's okay. You're learning this strategy now. That's what you're here for. So you can execute this, right? And perhaps for those of you that are tax professionals, you're going to say, hey, I went to this training. We learned a new strategy. I'm going to help you implement it. And by the way, this is going to save you, $1,500 a year. And, hey, your prices are increasing about $100 a month. So you're going to pay me for it as well. All right. So that's health insurance premiums. But guess what? You can do this for your HSA contributions too. All right. So this is basically the same exact thing that I was talking about when I was talking about the health insurance premiums. The only difference here is that the deductions take place on a different line item. So if we look at the line item here, it's just line 13 of the same schedule. So your health savings account deduction is taken here. Do the same exercise. If you have an HSA and you don't see a deduction here, you need to question your tax professional what's going on. So I'm not going to read this again because it's the same exact thing, but I want to show you an example of how we're doing it with a HSA. HSA family contribution for 2023 was $7,750. That's why I chose this amount. And we're doing the same thing here. If you add it to your reasonable comp, well, now guess what? Your reasonable comp is $47,750. Does it need to be? We already determined that $40,000 was your reasonable compensation. So what does this equate to in tax savings? This is another almost $1,200, right? Almost $600 for the employee and $600 for the employer. Is this making sense? You understand why this is a benefit? Okay. Now, it's going to get wild, okay? So far, we have this with just your health insurance premiums and HSA premiums, and it's already saving you $2,700 per year. That's what I love about this strategy. It's not a one-time thing. You're going to be saving this money for either yourself or your clients every single year. But what about the HRA reimbursements? You can actually do the exact same thing for your HRA reimbursements with one caveat. HRA reimbursements work the exact same way as premiums and HSA contributions with the one exception. You do not receive a Schedule I, Part 2 sort of above the line deduction for it. In other words, you are going to pay income tax, okay? You don't get, if I to show you that visually, nothing, there's no area on here to put your HRA. So the only savings that you get when you sort of funnel your HRA reimbursements through your payroll is the FICA savings. And that's what I kind of led with. I told you that if you go this route and you do the HRA, you're going to save about 15.3% in FICA taxes, okay? Now, I do want to pay or call this out here where I'm saying the only savings is FICA because it's a taxable fringe benefit for a 2% or greater S Corp owner, right? That goes all the way back to when I was kind of highlighting that. The reason why I did all of that for you so that you can see, oh, this is why it doesn't work this way. It's because an HRA is a fringe benefit, and so this is the way I have to treat it. If it was a the reimbursements would be non-taxable if I was a regular rank and file employee and not a 2% or greater S Corp owner. Okay. Couple things to talk about here regarding the HRA using an S corporation and doing the reasonable comp strategy is that a 2% shareholder of an S corporation cannot participate in that QSERA we talked about earlier, but they can participate in this regular sort of Section 105 HRA that I've been talking about this whole time. If they participate in the Section 105 HRA, they do not receive the income tax deduction of the HRA reimbursements, right? Because fringe benefits work differently for S Corp owners. The reimbursements would be reported on Schedule A as a medical expense where they are subject to those 7.5% AGI limitations discussed earlier. So what I'm saying here is you can get an itemized deduction for it, but we already established that that's pretty challenging to actually receive any benefit from that. You can still include the reimbursements to box 1 of the W-2 as reasonable compensation, thus receiving FICA tax savings, but they are not later deducted on Schedule 1. This is kind of a recap of some of the things I already showed you just a moment ago. So let's look at an example where you had $10,000 in medical expenses that you wanted to reimburse. And this slide looks very similar. It's basically the same exact math where I was showing you a $10,000 health insurance premium, but we can instead see that in box 14, I've got 105 HRA listed here and not a health insurance premium. So same thing applies, right? We've determined that your reasonable comp is 40. So why are we bumping that up to 50 when we don't need to? Our reasonable compensation includes the $10,000 HRA reimbursement as well as our sort of salary and wages, okay? Now, what you can do is like lump all three together. So if you're one of those people who are fortunate to have your health insurance premiums deductible, right? We said that that was 10 grand. You also participate in an HRA, that's 7,750. And you also have an HRA where your medical reimbursements or your medical expenses are 10 grand, you know, this starts to add up, right? That's $27,750 that you don't have to pay Social Security and Medicare taxes on. So that's a savings of $4,245 each and every year, assuming on average you have $10,000 in medical expenses to reimburse. And I would really encourage you guys, you might be thinking to yourself like, oh, $10,000 a year, I don't have all that. But like, hey man, the chiropractor, you know, that adds up. Braces are expensive. I personally had LASIK surgery a year ago or so. That wasn't cheap. And so you have these things. You just need to make sure you cross-reference these various medical expenses you have with that IRS publication I mentioned earlier. Carter was able to kind of use this example, and I'll steal it from him if I don't think he minds, where like someone really wanted to buy some really nice Cartier glasses, right? And so, well, that person is also somewhat blind. And so they got the Cartier glasses and they got the prescription lenses in them. And so all of a sudden they were able to deduct, Carter's words, not mine, $3,000. I don't know if glasses are that expensive. I would, I don't know. Me personally, I would never do that. But hey, to each their own. And in Carter's defense, Carter didn't do that himself, okay? He's a little bit more responsible with his money. Okay, but what about this? The medical C corporation. This is gonna be like sort of a novel idea to you. Mark and I kind of discussed this prior to the conference kicking off, and he was cool with me approaching it this way. So this is gonna be brand new. Even if you're in the Main Street tax program, you probably haven't learned this method. So if I bored you a little bit, time to pay attention because you're gonna learn something new here for sure. So as I mentioned earlier, what if I wanna save more than 15.3%, right? What if I prefer to save anywhere from 22 to 37%? And again, where are these numbers coming from? That's your marginal tax rate, right? That's the tax brackets, okay? So again, I said it earlier, but I'll just repeat it now. If all you want, like if your tax bracket, let's say you're in like, I don't remember all the tax brackets anymore, but if you're in the 12% tax bracket, then just run this through, I showed you a moment ago, run it as reasonable compensation because you're gonna save 15.3%. But if you're in a higher tax bracket, you might want to use this medical C Corp strategy. So what is it doing? We've got revenue flowing into your S corporation, right? You're used to that. And you're used to taking a W-2 from your S Corp. You'll still do that. I know I don't have it on my diagram here, but I wanted to simplify this. You're still going to receive your W-2, and you're still going to receive your K-1 income. But what's happening here is you're paying a fee to a C corporation that you're going to establish. And this C corporation is going to be doing a service for your S corporation. I'm going to unpack this a little bit further on the next slide, but I'm just letting you know. Your C corporation has an employee, and the employee's reimbursement consists of their medical expenses. Now, you can pay them in addition to their medical expenses if you want, but the primary reason people do this is to pay their medical as their compensation. And then the C corporation, I don't like the idea of zeroing things out to where like, okay, yeah, at the end of the year, my C Corp made no money. In my opinion, I don't like that idea. So you're gonna have a little bit of sort of C Corp income left at the end of the year. It could be a few $100s, but I just don't like the idea of having a $0 business, because that to me just is like, well, why are you in business if every year you don't make any money? Okay, so why does this strategy work? So unlike S corporations, greater than 2% shareholder rules do not apply to C corporations. That's why we run this through a C Corp and not through like a partnership or a sole proprietorship, okay? The S Corp, right, is now less profitable, so perhaps you can take a slightly lower reasonable compensation. For those of you that are in Mark's program, that probably makes a little bit of sense, right? Because in general, if you use the Kohler matrix to determine your reasonable compensation, it's based on the profitability of your business. So if your business, your S corporation is slightly less profitable, then perhaps your reasonable compensation is slightly lower. So it's saving you FICA taxes there. And as I said a moment ago, your C corporation offers services to the S corporation. The C Corp is going to pay those medical expenses of the C Corp employees. Okay, here's an example of this. So how do you execute this, okay? So let's say the C corporation is going to offer services to your S Corp, and let's say there are services like web hosting and IT related services, okay? I just kind of made this example up, so just go with me here. The S Corp expense, right? The money's flowing out of my S Corp and going into the C Corp. Well, the S Corp expense is the C Corp's revenue, all right? The C Corp employee compensation, would consist of the medical reimbursement. So we've been running with this example of $10,000 this whole time. So let's just continue with that. I'm saying, hey, the compensation to the C Corp employee is $10,000. The C Corp should be paying for expenses too, such as web hosting, email hosting, website maintenance, IP address security, things like that, right? Because we don't want to have a C corporation and the C Corp, in other words, the way I want to word this is like, assume that C corporation could be providing those services to any business, okay? Not just the one that happens to be yours, okay? And so that C Corp business, if it was, providing web hosting and IT related services, would have expenses of its own, right? It would have web hosting costs and email hosting costs and all that stuff. So make the C corporation pay that. After the expense is paid, best to have some C Corp income, not zero. I touched on that already. And the last bullet point here is the required C corporation is gonna have a tax return, right? That's sort of the downside of this. You're gonna have to pay to prepare a C corporation tax return and perhaps payroll as well. So you need to do sort of a cost benefit analysis to see if this is gonna work for you. Here's the cost benefit analysis, okay? So assume you're in a marginal tax rates of 30%. I think that's pretty reasonable. 24% Fed, 6% state. Also assume you've got the 10 grand in medical expenses. Well, what is your tax savings here? It's $3,000, right? 10,000 times the 30%. Well, the C Corp tax prep fees and payroll are $1,500, so your net tax savings is $1,500. Now, obviously, the higher your medical expenses and the higher your marginal tax rates, the better these savings are gonna be. So maybe as a general rule of thumb, if you're trying to I guess, establish this with your very own tax clients and maybe tell them like, hey, if you've got an average of $10,000 or more in medical expenses, because perhaps you have a child with autism or special needs, or these things aren't cheap to take care of, we now have a solution for them. It's the medical C Corp. It is going to cost them $1,500, but everything over and above, pretty much like $5,000 in medical expenses is a tax savings to them. Here's another confusing trifecta. No, it's not that bad. So I just wanted to show this to you visually, right? Everyone learns a little bit differently. I've been talking to you for 40 minutes now. This is a visualization of the C Corp strategy. You've got your S Corp here. It's paying for a service that's being provided by your C Corp, and your C Corporation has a W-2 employee, and that W-2 employee's reimbursement is, or sorry, I should say that W-2 employee's compensation is the reimbursement of medical expenses.
Okay, so I hope you learned something from this video. And I admit that was a longer video, but even still, I was only able to teach you about the topic of deducting your medical expenses and specifically taking a deep dive into the HRA, okay? I encourage you once again to click on the link in the description below or visit my website at navimuradcpa.com to learn even more about the course I mentioned earlier and all the various strategies that I have in there. And this video, although it was a longer one, I only had some limited time, right? But in the course, I can unpack all of the tax strategies I use with my very own clients, and I actually teach you what they are and how to implement them using QuickBooks. Although the course is designed for a beginner, I have tax preparers, bookkeepers, and even CPAs enroll in the program who share with me just how much they've learned. So don't feel intimidated just because you're a new business owner, and don't think you know it all either. We have a wide variety of students in the program who are all learning something new. All right, so with that said, I'll see you either in the course or in the next video.